Hello investors, welcome back to the channel. As a quick background, I'm a former finance professional. In this channel, we discuss topics like stocks, markets, options, investing, financial analysis, real estate, and personal finance. Please press the subscribe button below if you're interested in any of these topics. In this video, I'll be discussing 3 key elements of stock analysis that will help you identify the next Amazon, American Express, and Costco with more than 20 times growth potential. In every stock analysis, there should be 3 key components: durable competitive advantage, financial analysis, and valuation. In this video, I'll be going over the first of the 3, identifying durable competitive advantage, which I'd argue is the most important one out of the 3 because a company's financials and valuations are simply reflections of a company's competitive advantage. I've been noticing a lot of people are leaving out some very important components of stock analysis or taking big leaps in assumptions. For instance, many people nowadays seem to be making premature conclusions along the lines of the US government is pushing for clean energy initiatives and therefore Tesla stock will be going up. Or Amazon reported sales growth of 40%, so the stock is a buy. Or Apple makes great phones and therefore Apple stock is a great investment. If you notice, these statements are taking big leaps in assumptions. There are many factors that go into investment decisions, and we need to think from multiple angles, not just one-dimensional level, such as Apple is introducing a new line of products, and thus Apple stock is a buy. We need a more in-depth analysis than that. I think the best way to learn is to take a look at an example analysis. This is an example copy of a one-pager stock pitch that covers all 3 elements: competitive advantage, financials, and valuation. For those who would like a copy of this sample stock pitch, please sign up to the email distribution link below and you'll receive a copy. A competitive advantage is when a company has an edge over its competitors. Most people subscribe to Netflix over renting DVDs because it's much easier and cheaper to stream on Netflix than renting $10 DVDs. This is called competitive advantage. For instance, a lemonade stand may have a competitive advantage over an orange juice stand because it can make lemonades at a cheaper cost than the orange juice stand. A Google search engine has a competitive advantage over Microsoft's Edge due to the superior search algorithm and network effect. A durable competitive advantage is a company's edge that is a lasting one. To use the previous examples, can the lemonade stand continue to produce lemonades at cheaper cost than orange juice stand? Is Google able to maintain its superior search algorithm and the network effect over time? A company with a durable competitive advantage is the one whose stock price will grow over time. If a company's business model does not have a durable competitive advantage, it won't survive for the long term, no matter how cheap you can buy it. It's sort of like buying a company that produces flip phones. Remember these? Sure, you could be buying this company at a bargain PE of 3 times, price to earnings ratio. But is it really a bargain? It produces an outdated device with no real competitive advantage over other products, and therefore it won't see any type of growth and its stock price will cater. BlackBerry also may have had a competitive advantage at some point, and that's why it became so widely used. But the advantage didn't last for long, and it turns out the competitive advantage was not a durable one. Every company you look at should have a clear, durable competitive advantage. For instance, what's to keep Thor Industries, the largest manufacturer of recreational vehicles, to operate competitively? Because it has the largest and most efficient manufacturing plants and largest dealership network in the world. There's a high barrier to entry for any new entrants to compete. Management has been known to be great capital allocators, meaning they know when to issue debt to build a new manufacturing plant, acquire a business, or buy back its own stock. These points back up the claim that Thor has a durable competitive advantage and will keep the business growing. My favorite way of identifying this edge is to try the product or service because a customer is usually the best judge of a value. You could easily try Starbucks, Shake Shack, and many other products from consumer companies. For those that are business-facing like Salesforce, you can find surveys or product usages. Most of the times, however, a great product or service will always show traction in early stages. Amazon, Facebook, and PayPal were gaining 200% new users every year in its early days. American Express had a crazy growth in its early years as well. Take Upstart, for example, and this is one of my favorite companies at the moment because it's in a very sweet spot of growth and valuation. It's growing sales at 90% clip year over year. That compares to average 15% growth for its peer companies. Without even testing their product, I know something is working right with the products it's offering. as evidenced by the sales growth. One important thing to be mindful of is that sometimes these growth can be non-organic, meaning the growth can be a result of acquisitions or aggressive marketing spending. If you're growing your sales at 70% year over year, but your user growth is only 40%, that is a bad sign. Alternatively, if you're giving excessive concessions that your economics doesn't make sense, that's also an issue. For instance, remember MoviePass? They were charging $10 per month to watch an unlimited number of movies. While the user growth was exceptional, this model was clearly unsustainable, and we should be wary of these kinds of business models. The bottom line is that whenever you're looking to buy a stock of a company, the company should always have a durable competitive advantage in order for its stock to 10x in the next 5 to 10 years. I'll be covering the second component, financials, in the next video. Thank you all for watching, and make sure to press the subscribe button below if you liked the video. See you on the next video.